All right, so the market started off the week coming out of the Easter weekend with a really significant bullish move. Lots of breakout signals today. I'm going to break all those down. It is a longer video than normal today. This is my last video of the week. I'm leaving on vacation to Hawaii for the first time with the family tomorrow morning. So I'll be gone the rest of the week. So as you watch a longer than normal video, that's the biggest reason why is this is all I've got. We also didn't do a video on Friday because of the holiday either. So this is kind of catching us up and then giving you something to digest over the rest of this week. Brandon will still be here on Tuesdays and Thursdays as normal, but there won't be a market outlook on Wednesday or on Friday or the next Monday. Because I'll be gone here for about a week. So that's why the video today. But it was a significant move. Like, the market sure didn't want to send me off without something to talk about. We have a lot to talk about today, a lot to cover. What drove a lot of today's price movement? I'm going to break that down and how to trade it. So let's go ahead and get started. Today is Monday, April the 5th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. We have officially completed the 5th month of this current intermediate rally that we've been on this entire time. It appears that we're getting a little bit of a flourish right now. This is really since the beginning, beginning of last week, we've really kind of taken off here on the S&P 500. That near-term line has spiked up to pretty decently high levels. The intermediate line, of course, back up to high levels above its rising long-term market sentiment line. The momentum line kind of in the middle, stuck here. Again, this is coming off of last week's overbought cluster that we had. Another overbought cluster on the S&P 500. This is our fourth one during this current rally. We had 4 there. I don't think 4 is a magic number in the least bit. But we are getting a cluster of clusters again, very similar to what we got going into the COVID peak. Very different than what we normally get when we kind of spread the clusters out. We can get a cluster of clusters on the downside, usually on the daily chart, more so on the weekly chart. But to get a cluster of clusters up here on the upside, and especially on a weekly chart like this, is a little telling. Of course, the month's not over with because the month barely started. But so far this month, we're getting a cluster this month, including the market sentiment, which we've had. All 4 of these have included market sentiment. This is our furthest away that we've been from the 30-month moving average. That's a 30-month moving average that you see there on that green line, because we're on a monthly chart. Just to kind of give you an idea, in the last 10 years, it's the highest we've been. If I were to go back, say let's just go back to 1950. Go onto a monthly chart here. You can see it's not the highest, but it's up there, right? The 82nd percentile. You can see if I were to put this dotted to kind of give you an idea of where this is. If I were to put that at 2916, that's where we're at right now. That's higher than this cluster that we had. We're higher off the moving average than we were in April. That's April, mind you, 2011. We were high, but the problem with that one is we were coming from below the moving average. Obviously, we came from below there, but not from a falling moving average like we had back then. Excuse me, I'm trying to keep my throat moist there with some moisture. But if you come back over here to the 90s, to the late 90s in particular. Obviously, we were this bullish and continued to be this bullish for quite a while before things started to melt down, so to speak, a little bit. So those are some of the only time frames that we've been this bullish. A lot of people have compared. I've seen comparisons to where we're at now to this period in 1983 that led into that period of weakness going into 1984. But temporary, just barely temporary, as we rallied into the 87, and you can see how bullish we were going into that big 87 drop, And I compared that COVID drop to 1987, and you can see how bullish we were going in. As you saw on the weekly chart, how bullish we were going into this COVID peak. We were that bullish. We were really, really bullish going into that 1987. So you can see why we fall so far, because we were so far up above. We were 30%, nearly 40% up above that 30-month moving average in that particular case. And look at some of these are some other periods. Remember, the blue dotted line is where we're at right now. Some other periods where we were this far up above the moving average. Now, granted, the month's not over with. It's hardly over with at all, but it just shows you just how bullish we are. It's kind of something I tweeted out. There's a lot of chatter about, here, one second. There's been a lot of chatter about the about the strong economic data. And something to keep in mind, and this is kind of what I posted on Twitter, is when we went into COVID, this is pre-COVID now. This is right before the peak, right before we started the drop. We were that bullish. We were 2 standard deviations above the 20-year linear regression trend line, which is a very long time frame here. And yes, I have it on a I don't have it on a log scale. The linear regression doesn't change with the log scale. It just changes what it looks like. But still, its relationship to the lines is still the same. It just curves it because of the log, and so I want to keep the lines from curving. But you can see. So here's the COVID drop, and all that COVID drop did was get us barely below the midpoint, right? I mean, if you kind of draw a line coming up this level, I mean, that's the pace. That's the 20-year pace for the stock market. We were just barely below that. So it took that big of a drop just to get us barely below the pace, because we had been above the pace for so long. For multiple years had been above the pace since the elections of 2016. And then this is now back up to this. So there's the pre-COVID peak, which at the time was 2 standard deviations above. There's the drop, which at the time was barely below the median. Now we have gone back up to 2 standard deviations, which is a lot higher than we were there. So needless to say, we are well above the pace. So any big stock market movement we expect to get from today going forward, because of all this great economic data the market's anticipating, that doesn't put in mind the idea that the stock market is a pricing in mechanism, right? We are 2 standard deviations. Why are we 2 standard deviations? If we haven't already gotten those big economic data, recovery data, then why are we already beyond where we were before COVID even hit? Because the market has priced a lot of this in. So we've had a really significant move to get to this point, to say the least. But there's a reason why we've gotten to this point, because of what we're about to see in the economic data. So keep that in mind if we're expecting the markets to be really bullish going forward because of the economic data, that the markets have already been very, very bullish to get to this point. And that's kind of what I share with you too about this rate of change. I mean, these are high record levels for the rate of change on an annual basis. As you can see, we're still 60% 1-year rate of change. I mean, that's a very, very high level. Again, to kind of give you an idea, 61.38 is where we're at right now, and I'm just going to dot this line. So that's where we're at right now, and then that line's the highest that we've ever been, right? So just to kind of give you an idea here, and again, I'll just go back to this 1950 area, back when the S&P became a 500 stock index, right? So if I were to kind of zoom out here to see, there's one other period that we were even higher than we are right now, and we actually continued higher from that point back in 2010. You can see in 2004, coming off that low, we never did get that 60% high. And then you can see going all the way back to all these levels, all the way back to 1950. We never did get this high as we're at right now. So, I mean, that just kind of shows you, and you can see that wasn't even, we never did get this high before. So these are record moves in the S&P 500, in the Russell 2000, not so much in the NASDAQ, but pretty much. The difference with the NASDAQ is you had these moves that got you up over 100%, 125%. So we're not nearly as overbought. We got up to 88% is as high as we got compared to those 2000, 1990 peaks. I mean, that's about where we were over here, and that was in the late 90s. We had a really strong move, and then we just were grinding higher throughout 99 until we made that tremendous move to the upside that, like I said, got us to 125% 1-year returns, which is just insane. So we're not anywhere near. This isn't anything like the 1999 bubble, but we're getting really darn close. Like, it's definitely not the same as 1999, but there's nothing since that has been similar. You can see the 20-year average, the 20-day average of the stocks above their 200-day moving average is up to 86.5%. 86.5% there. Let's see if it's updated for today yet. No, it still has a Thursday. So that's still a really, really high number, and that's just the average, right? If I just look at the current value, we're above 92%. We just barely got above. That's higher than we were over in the end of the year. That's a higher level, having 92% of all the S&P 500 stocks up above that level. Again, it just shows how extreme these indicators are. Here, let's go to the S&P 500 on the put call, and we won't do any kind of smoothing at all. Again, you can see we've been lower, but there's the put call index and how low it's gotten. More than 1 standard deviation, nearly 2 standard deviations down. So very extreme. In fact, if I were to smooth that out, you can kind of get an idea how it's rallied up here a little bit. It's not as low as it has been when it was at the beginning of the year here in February, 2 standard deviations below. And then there's your PE ratio, and there's the 1999. See, we're not anywhere close to that. We're getting there. We're higher than we've ever been outside of that, but we're not anywhere near that. So this is not like 1999. The types of companies that are producing these returns are much different than the types of companies we saw in 1999. These are pretty solid companies with some pretty significant businesses that they're doing. Not nearly the same as you saw, but still very strongly bullish nonetheless, right? Nonetheless there. So, and you can see the NASDAQ has changed its pattern and broke back above that 23% retracement level on last Friday. We're still kind of hovering around these highs, followed through on that today and really busted out, and now has dark green shading and a green line again, breaking up above its market sentiment level and a blue line. So that pattern right there tells you the NASDAQ has finished its pullback. It had a pullback, right? The others didn't, but this index did have a pullback, and now it has finished that pullback and has started up again on a new intermediate run. How long this run will last, I don't know, right? I would venture to guess it won't last as long because we haven't gotten a pullback here, and we're going on 5 months, and that's a really, really long time when the typical time frame is 1 to 3 months without an exhale of at least this proportion, which this type of exhale right here is about the weakest exhale you could possibly get and still be deemed, by this indicator at least, an intermediate pullback. Finally, your Russell 2000, you can see we are back above. We held that breakout back above the moving average. The intermediate line has not quite crossed above 50 yet, but it's working its way there with the near-term line now up in the reversal zone. So it's not as strongly bullish as the other indexes, but you can kind of see how things are definitely turning around as we make, I don't know if this is a last run or if we still, how many more near-term runs we have, because of course that's what we're on right now. The intermediate run that we're on, this entire intermediate run, is a collection of near-term rallies where the near-term line rises above 50 and down. So here's one near-term run, a near-term pullback. This is the next near-term run. Obviously the higher highs coming off a higher near-term low. And the question is, that was a pretty bearish near-term pullback, but that was also about as close to an intermediate pullback that we've gotten, right? It actually did turn into one on the NASDAQ. It just did not turn into one on the S&P 500. As you can see, when I do a comparison chart here, they kind of diverged a little bit. Here we go. They kind of diverged a little bit here. Let's see, let me just make sure I've got that. No, it didn't do it. NDX. There we go. At that point, right? So we continued down, but the S&P started to go higher, and the NASDAQ stays. See, like at this point here, this got to the index, the S&P got to higher highs. The NASDAQ did not get to higher highs. But you can see while the S&P now is to much higher highs now than we were there. That's the case on the NASDAQ and the S&P. We are catching up to, the NASDAQ's catching up to these highs and trying to do a little bit of a catch-up trade of its own, as it's been a pretty significant laggard here lately. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, that you liked the video, of course. And number two, it lets us know that you want us to do another video again tomorrow. It's a quick way to give us feedback and show us that you like our videos. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do and you want to let us know, the easiest way is to do it with one click right now. Is just click that thumbs up down there. That goes a long way for us. We really appreciate it. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. One of the things you get access to is our Market Outlook community, our forum on our website. You can be able to interact with other market scholars as well. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're looking at watching our video on our website here, check out some of these other things over here on the right, including, as you can see, the Market Outlook live video. So every day I do the Market Outlook, I also do a live video. I review all the trades that we're still in from other Market Outlook videos that we talk about here, because I do a trade idea at the end of the video, right? So I've already put that on before the market closed today. So I do that also in the Market Outlook Lives. And then we continue to manage those trades. We don't do that. I don't ever do that here in this video, but I do that in this Market Outlook Live video. So click there to find it, or you can also find it up here under, if you mouse over Market Outlook and click on Market Outlook Live Trade Review. These are all of our trading rooms that we have coming up, so check those out as well. Again, all of our paid subscribers, whether you're a monthly subscriber or a premium subscriber, you get access to all of our trading rooms, as well as our Market Outlook Lives. Of course, our premium subscribers get access to a lot more than that. If you click on the word pricing here, you can see a comparison between the two. That's why most of our subscribers are premium subscribers. We get access to all these premium tools and resources. So check all that out there. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also come down, hit this thumbs up icon. Opens up another new tab. Come down here, hit that like button. Again, the more you do that, that really goes a long way for us, because the more engagements, likes and retweets and comments that these posts have, the more Twitter and Facebook will promote our content to all of our followers that follow us on these accounts. It also benefits you because they will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, now let's take a look at the weekly chart and look at that nice, good bullish candle we got there. So, again, a higher, now granted, we're only a week into this week, a day into this week, so take that, keep that in mind. But still, a higher high already, that's set there at least. We get a higher close so far, which pretty good chance that that's going to stay there too, and then no lower shadow. And we'd have to come all the way down to 39.52 to get a lower shadow. So that's pretty unlikely too. The PPO still remains very, very high. Again, that's the strongest long-term momentum of the last nearly of the last 20 years. The only one that's been higher is a few weeks ago when it was slightly higher than 8.09, and we got to 8.43 there. That looks like that was the highest there at 8.43 right there. So that's the only other time it's been higher than the 8.09 that we are now. So in the last 20 years, very, very strong long-term momentum, to say the least, in terms of how bullish we are. And also too, when you look at it from just how far up above that 200-day moving average, the current price is at 12%. We've been above this level for this high, at these high levels, for very, very long periods of time. You can see some of these other periods not so long. This is kind of where we got to when it peaked. On some of these, we were up there for long periods of time. They were coming off of major lows, and then you can kind of see what happened afterwards. So that's kind of where we're at now. Lots of green dots over here. Lots of green dots, lots of green dots, lots of green dots. And we'll see, if we ever get this type of move, or this type of move where we come down and retest that 200-day moving average after getting the golden cross there. That's on the Nasdaq. Remember the S&P. Then the Russell's the one that had the bearish candles, and now we're back to a bullish candle this week. So that's a good sign for the Russell. And then the Nasdaq, look at that reversal. So very strong reversal for the Nasdaq coming off this 38% retracement level and back above the 23. So an opportunity for, at the very least, a divergence, a bullish divergence to occur up above 14,000 will probably be by the time we end up finishing this next little intermediate run, however short it ends up being, will probably end up finishing right around above 14,000, enough to get some kind of divergence, right? I would expect when you look at it on a weekly chart like this. You can see above 60, above 200, very strong breakout there. Really confirming Friday's or Thursday's move, excuse me. But when you look at it on a weekly chart here, let me go to a weekly chart and put it in some context. Again, more than likely we'll probably finish this little rally here above 14,000, so above that high point. The question is whether these will get to new highs, right? Will the CCI get up above 70? Will the RSI, excuse me, get above 70? Will the CCI get up above this 158 level? That's the question in terms of how bullish we'll end up being. Is unlikely that something like that will happen. When you look at it from this perspective on the MACD and the stochastics, of course, very strong bullish move here. The MACD is crossing zero. Stochastics finally getting, even the orange line's turning back up above 60 again potentially. Very, very good little breakout pattern again. Very confirming Thursday's break up above that line. Just really kind of confirming that move on the Nasdaq. And again, looking at the weekly chart, a longer term view of this, very unlikely we'll get new highs here, which means that more than likely we'll get a divergence, but not until we get up above that previous high. So like I said, more than likely at least above 14,000, if not closer to that 14,500 by the time this run is over with. The question again is the length of time, and that's going to be dictated by how long this can go without at least a period of this that we haven't, like this kind of pullback that we haven't had yet on the S&P, that we did have on the Nasdaq, but we didn't have on anything else. We didn't even get on the Russell. We came very close on the Russell here on that little drop on that period of weakness, but even that's not doesn't constitute a real intermediate pullback. And if that is dark pink shading and red line for 3 days, in a brief dip below the 23% line, there's multiple factors that we look at. But if that is what defines that pullback, then that might be one of the weak. I mean, that would put this pullback over here into that's no longer the weakest pullback that you could possibly have had. That we had in September, October. If that's as much as we got back there. That this would be even weaker than that, because at least that produced an oversold signal. And of course, the Nasdaq, pulled back a lot more there, and the S&P actually pulled back a lot more there. You just didn't see the same weakness in the Russell 2000 at the time, because it was really moving into a catch-up mode at that time. One more thing I wanted to look at on the Nasdaq, kind of confirming this breakout pattern. Here's the DMI breaking up above 30, so we're not quite getting the break down below 20 yet on the negative index, so kind of keep that in mind. But still, breaking above 30 on the positive is a very, very good sign from a breakout perspective. That you can see on the IWM, we're still not really there yet either. And then on SPY, we are. I mean, look at that, break back above 20, break down back below 20 on the negative, above 30, excuse me, on the positive. Very, very good breakout sign here with the ADX as low as it can be, looking like it's trying its hand at another run, right, and to continue this run. And on the trend strength indicator, we are finally up above that 1 level. So we have a weak trend going here. This weak trend, we cleared up above that 1%. So we have a very weak move going, and we're almost above 65 where we'd have a moderately strong. So this blue line here is kind of in conjunction with this green dotted line there. So we're not quite there on SPY. In the Qs, finally we are breaking out above 1%, above 50. So, above the cloud, nice little breakout that we didn't have yet on Thursday. Nice, good breakout there too. And you can see as well with the red line crossed through the price again from being below it for a while. So lots of breakout signs on the NASDAQ today, really kind of confirming. In fact, if you look at one more thing I wanted to look at on the Qs, besides the Arun indicator, which we've talked about before, we talked about that on, let's see, was it on, maybe it was in my class on Thursday, the portfolio management class. We talked about that pattern getting up to 100 and down to 0, very bullish pattern at the time. And then we obviously still have that there. So very bullish crossover there. And then the last thing I want to look at was this TTM squeeze. And you can see we broke above the Keltner channel today. So with the bands in between, we finally broke through here, broke through the upper Bollinger Band, broke through the upper Keltner channel. So lots of breakout signals all sitting on top of each other today. If we don't hold that today, that will probably be the mother of all fake outs. Otherwise, more than likely, this is going to make a run through 340, maybe up to 350, above 14,000 on the actual the NASDAQ index itself, not the ETF that this is, but up above 14,000 here, and then like I said, getting that divergence probably up to about 14,500 or so is where we'll get to at least by the time this is all said, if it does not turn into, like I said, the mother of all fake outs. And we should know by the end of this week, if we fill in these gaps by the end of, which is on the SPY, it would be this gap, and that gap, right? We haven't filled in any of these gaps from last Wednesday, Thursday, or today. If we fill in those gaps, even down to 394, and just fill in those three gaps, needless to say, like this one over here, but if we fill in those three gaps by the end of this week, then that will be the mother of all fake outs. More than likely, that's not going to happen. As you can see, this would be these same three gaps. A move down to 313 would fill in those same three gaps on the Qs. And this one in particular just has very little volume. And I kind of mentioned today that when you look at it from this perspective on the price movement, that today's move was the biggest gap up we've had since the 9th of March 9th. And you can kind of see, the gap and the finish, the close, not coming off of a big move to the downside, which is usually when you get these big moves, you come off a big move to the downside, right? And that follows with big moves to the upside, all of these. That was not the case this go around, right? We are kind of moving up and kind of getting more and more gappy, and we're getting more and more bullish with the historical volatility falling, producing another big gap between implied and historical. In fact, implied jumped up a little bit today, which is always the case on Mondays. But that gap, it got even bigger today there. In fact, if you look at today's volume and trading range, again, 91 million. If you look at the trading range today, we had a range of 3.5 points. The close here at 461, the low at 403. So you had about 3 more points of gap. So you really about 6.5 points was your today's range. That's above the average. That's well above 1%. And then the volume at 91 million. that's a pretty decent move. That's a pretty decent range. That's not your typical bullish range to be that bullish. We should be getting very, very small ranges of less than 4 points. Including the gap, the overnight gap. And that wasn't the case today. So with the volatility index still very, very, very low, even with the jump higher today, still very low at this 85% mark, kind of gives you, and remember again, when you look at 85% at 17 versus 85% over here at 22, then this index down here is telling you that we're a lot lower now than we were back then. And that's one thing to have that be the case, when you're 2 months apart. It's another thing for that to be the case when you're only 2 weeks apart. So it kind of tells you right now the VIX is really, really low on a relative basis, relative to where it even should be right now. So, again, just kind of keep that in mind, that like while the Nasdaq has had this great pattern, breakout pattern today, coming off of a intermediate low point, right? Because it did have an intermediate pullback. We never did get that exhale breather on the S&P. So, we're still taking a breath in and have been for 5 months. And now that the Nasdaq is taking a new breath in, the S&P is and the Russell for that matter is still taking in the same breath and still holding that inhale for quite a while. That's gonna, you wonder how much of a limiting factor that will be on this new run on the Nasdaq as it kind of plays its own little catch-up game that the Russell has been doing for the last so many months. In fact, when you look at it on this basis here, right here, you can see, we finally did get up above, and we're still up above the 30-day moving average, the 8 and 17-day exponential crossing above. The RSI is moving up. The MACD is positive. The PPO is the histogram is positive. They were crossing up above its moving average. Pretty decent levels. So the Qs are now playing their own little catch-up trade. And so far, it's been in a bullish move in the markets. You wouldn't expect it to continue this catch-up trade while the broader markets still are bullish, because, again, that's a long inhale that we've never exhaled from, except in only the NASDAQ 100. All right, so what does that all mean? That means that we're still in a bullish trend. It might be mature, it might be a little extended, but we're still on a bullish trend. And now you're getting the generals joining the party, right? The big, large cap tech leadership, which has been the leadership for so long, which has not been the leadership during this current intermediate rally. They're kind of taking hold here at what may be the ending of the intermediate rally for however long that may last. It could be a month, it could be 3 months. Which would make the S&P's rally 8, which would be very, very long. I don't think I've ever seen one that long. But that doesn't mean it can't happen, because anything can happen. But it just means, again, that the longer we go, the bigger inhale we take, be prepared for a bigger exhale. Not that I think the market's going to fall off a cliff. I don't think it will. It's just the nature of how Fibonacci retracements work. They're percentage-based retracements, right? So, if you're going to have a 38% retracement of a 10% move versus a 38% retracement of a 20% move, then it's going to be twice as big, right? A 38% retracement of a 10% move is a little less than 4%, which means a 38% of retracement of a 20% move will be a little less than 8%, right? That's just the nature of how percentage-based retracement works, and we're going on about a 26% move on this current intermediate rally that we haven't on the S&P that we haven't finished yet. So that's okay. Just be prepared that if you're loading up on bullish trades now and there's nothing, we haven't stopped making bullish trades. You should still trade the trend. Just know that as this thing keeps on going, that just be prepared for the type of exhale move that we've seen previous to 2018, the beginning and the end of 2018. The COVID type low, these exhale type moves coming from extreme moves to the upside, they tend to be pretty, because they're percentage-based retracements, they tend to be bigger than what a lot of people are comfortable with, right? Like, they'll think that a 20% drop is a bear market, and the reality is a 20% drop, and we've been up nearly 100% in the past year, is not a bear market. It's just the reality of a very big bullish move that we've been on since last March, that we're still on now, and that we might still be on for another few weeks or maybe another month or so, for all we know, as that NASDAQ's move today looks very breakout-ish. And like I said, if it doesn't hold by the end of this week, then that very well could be the mother of all fake-outs. And I don't think that's going to be the case. I think the NASDAQ is breaking out to a new intermediate run for itself that now is going to coincide with the current mature run the S&P is still on. So that's going to, how those two work together is the big question mark. And I think it will be a limiting factor, not to a day, not limiting the new run to only a week, but limiting it to a month, very, very feasible, because then that would be 6 months on the S&P. And I can see something like that, very, very likely scenario. So, and then producing the divergences that we saw last year going into the COVID move, that even without COVID, would have produced a pretty decent exhale last February going into March. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know as to why. What indicators or charts are you looking at that makes you a lot more bullish, right? That, you know, 8 or 9 month intermediate run is not out of the cards at all because of whatever charts you're looking at, or what charts are you looking at that makes you a lot more bearish than I am? That this breakout signals that we're seeing on the NASDAQ, that you're leaning more towards the mother of all fakeouts for all we know. What are you looking at that suggests that? Share that with us in the comment section down there. All right, so now that was a very long technical outlook, but now I'm just going to kind of briefly go through these different asset classes and the sector outlook. Here's just today's move. You can see it's very, very dominated by large cap. There's your Qs up 2%, the S&Ps up 1.5%, the developed markets, small caps and emerging markets not so bullish, right? The dollar was down all day today, as you'll see here in a second. Is a very good sign. Long-term bonds and commodities were down, so bond yields were up and commodities were down. That's a little interesting pattern. Again, not a pattern you expect to see, that combination. When you look at it from this perspective, let's take a look at the dollar first in comparison to the euro, which is 60% of the dollar index. You can see the rally. Like, again, we got this move down to that low point. We looked at that as a potential support level. We talked about a bounce off of this, kind of coinciding with some bullishness and risk appetite, more broadly speaking. The question is going to be how far up will this go, and it's going to meet some pretty significant resistance up here. And when it gets back to the moving average and back to that line, that's about as long as I expect this bout of risk appetite to go, before I think we end up retesting. Probably not down to this line, which that's that big long-term line over here. I expect the next time we come down here from wherever we end up peaking, we might end up peaking up here at 119.75 again. But wherever we end up peaking in this area, I expect we'll come down to this 117.50 the next time and probably stay here. That's where that 78% level is. That's where the orange line is, the 38%. That's going to be where I don't think we'll get back down. But that held for support like we thought it would, and we're continuing to rally here today. But the interesting pattern was those yields. Yields are kind of, stalling after being so bullish. They're stalling a little bit. You can see how we're converging with the moving average. When you look at it from a directional movement index, here you can see we're so bullish. Obviously, we're consolidating lower highs with the higher lows on this negative index, right? So that's not surprising at all. Here's the inverse of that, which is TLT, the big bearish move we've had that's now stalling as these indexes are reversing. What's interesting is this commodity trade is really turning bearish. We kind of bounced up on Thursday, and the question was how much. I mean, we're in a pretty strong bearish move right now. Are we going to be able to break down here below that 23% level? So, again, kind of keep that in mind. Keep that in mind there as you take a look at whether or not this ends up being a fake out pattern. Today's move kind of, and like I said, a little bit of an exhaustion type move. Will this end up being an exhaustion gap or kind of a breakaway gap? It has a lot of lookup breakaway. Will end up being a breakaway gap there. It doesn't have the increase in volume that I would expect with a breakaway gap. So that's why, but it also, exhaustion gaps tend to have a lot of volume associated with them too. And more than likely, that's just kind of a common gap, which again, if we end up filling in, even just down to 395 by the end of the week, that's gonna produce a long upper shadow and some pretty significant bearish, if not a kind of an engulfing pattern going into next week, depending upon where we close. Either way, kind of producing a pretty bearish pattern on the weekly chart. We'll see how it ends up closing. I'm still leaning more towards that it'll probably end up holding this breakout and probably end up holding a lot of this gap here. But if it doesn't, then we'll know why. Let's take a look at the sector performance of the same move and what sectors outperformed here today. So let's go to the sector comparison, and then we'll go just to today's chart right there. And there's our sector performance, XLY, C, and K. Again, they've been the biggest laggards. They're catching up. Last little catch-up trade. There's your biggest winners. Look at energy. Those are your biggest winners since this intermediate run began for the Russell 2000. The intermediate run began in September of last year. For the S&P, it began a month later. But you can kind of get an idea of just how long we've been this bullish. And I mean, there's your big winners, and there's your losers down here, and your safe haven trades. Here's your laggards trying to catch up a little bit before potentially this run ultimately ends. Again, most likely won't end tomorrow. Most likely won't end by the end of the week. But give it another month or so and let the NASDAQ kind of outperform briefly, and let the euro make a run up towards some resistance. Then you'll probably see more of a longer term exhale than what we've seen so far, where it's been limited to just the NASDAQ 100, large cap tech, and briefly into almost into the Russell. Here's the 12 grid for all these different sectors. So again, those three have been the most bear. I mean, look at that breakout on XLK and XLY. Look at that breakout there. So we are already back, that far above the moving average, where like some of these other cyclical areas had been. Materials giving us an overbought cluster, XLI, there's XLP, there's our safe havens, really bullish still, and then your financials, your healthcare, your energy, not nearly as bullish. But why are we breaking out now? Because of that, right? Big breakouts on these areas that had been the weakest performers. The question is how long that will lead to a new intermediate run for a lot of these big sectors. All right, so when we look at that, when we talk about how to trade that kind of market, then of course, there's your bullish moves, and it's kind of hard to chase that kind of a bullish trade with a lot of those gaps there. So you say, okay, well, you get a lot of these types of moves, we can make a trade that sets us up for more of a sideways action. Let me show you our example for our trade idea that we did already in the Market Outlook Live on Square. So Square, there's the little rally we've had here. It had been bearish, like a lot of these other large cap tech names, relatively large cap. But you see how now it's bounced back up towards the middle of a range that it's been in. In fact, when you look at it from a Bollinger Bandwidth perspective, there's the big volume node that we're trading around right now. It's a very, very good opportunity to trade a sideways trade strategy when you've got a big volume node acting, with its own center of gravity, keeping the price, it'll still go up and down, but keeping it centered around that big volume node. And we happen to be in the center of it, right now. If you look at the DMI for Square, you can see we had a pretty decent bullish, a directional move. We don't have a directional move going on right now. If anything, we're kind of meeting up with some resistance here. Look at the RSI and the CCI. They're also in very neutral ranges between 100 and negative 100, between 40 and 60. You look at the three green arrows here, you can see how they're converging. They have been bearish, but they're converging back towards zero as the lines are sitting right on top of each other there. So a lot of sideways action. If the markets stay bullish, we have some opportunity to the upside. If the markets stay bearish, but with limited bearishness, then we've got some room to the downside to work. And that's why you can do trades like this sideways selling a call option. You have earnings coming out, but if you sell the 200 to 20 delta, buy the 190, going $10 wide, because over here you have to go $10 wide on the call side. So we'll sell the 270 at the 20 delta, buy the 280. It sets us up for this trade here. We ended up getting $335 for it. For a risk of $665, which that's our typical return that we shoot for on these kind of short premium trades. But typically we have to put $1,000 at risk to get that. Here we're only putting $660 because of the earnings, which is a great thing, because now as long as we stay in this sideways action here, then we can be able to maintain. Here's the Ichimoku cloud. We can be able to maintain a pretty decent return going in the May expiration. Without a lot of risk, right? We're still going to risk. We still want to get out. If we lose 335, we'll get out. But worst case scenario, I'm not putting $1,000 at risk to get that 335. So that's a nice thing about the earnings, the increase in volatility in the premium, is it allows me to get similar returns for a lot less risk than what I normally have to take. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Remember, all of our subscribers, even our free subscribers, have access to that. Open up any new threads you want there with any questions or comments you have. Reply to other people's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video down below. Have a great rest of your Monday night, everybody. Have a great rest of your week. And we'll see you all next time. All right, goodbye, everybody.